Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. I'd like to talk about the equity markets this morning. Equity markets are a little bit falling into a little bit of a pause or a little bit of a stall. Last week we pretty much saw all the indexes were negative for the week, anywhere between 1 and 2%. And that's really not surprising, as the indexes ran into resistance levels after having a multi-week run. So we might be digesting in this area. Furthermore, as I mentioned last week, the S&P trying to get through that 2070 to 2100 level. That's a level of very heavy congestion. That's where the market traded most of the year. So it may take some time to get through it, if it can get through it at all. Similarly on the NASDAQ, if it can get through that 4920 to 5100 level, it might see some daylight. But right again, it's running into that resistance level. Now, as long as the S&P and NASDAQ stay above their 200 days, we're pretty much in pretty good shape. That's 2014 would be the first support level on the S&P, and about 2,000 below that. On NASDAQ, that 200-day line's right about 48.60. If it slipped below it, as long as it stays about 47.50, we're still pretty much in an uptrend. Now, there are a few warning signs, or perhaps worrisome signs for the equities, and namely is that there does seem to be a trade going into safer havens, meaning bonds. Bonds have been doing very well, and the yields have been doing poorly, and that's kind of bad for stocks. You know, 10-year yield was down 4% last week alone, and that's reflected also in banking stocks and financial stocks. They're the whole laggard in this market, and it's hard to really have a great market rally without those groups participating, particularly banks and financials. The other thing we're seeing is gold stocks. Gold stocks are just on a tear. Initially, it looked like it might be sort of a dead cat bounce. There's a lot of gold mining shares that pretty much have doubled since the February 11th bottom in the market. Actually, a lot of these stocks started rallying since about January 20th. You can take a look at these charts, especially some of these smaller miners like Yamana Gold, symbol AUY, Anglo Ashanti AU, or DRD Gold. And we see the same thing in some of the larger gold stocks like Barrick Gold, Newmont Mining, Royal Gold. So that's something to kind of keep an eye on how the market plays this out. Another defensive sector is doing very good are the REITs. So the market's almost telling us that the Fed is never going to raise rates. At least that's what the market believes at that point, and that may be bad for equities. So with that in mind, the situation remains fluid, but we do continue to look for setups in growth stocks because we do think things will still be positive. Now, this week also kicks off earnings season. Now, everyone knows already earnings are estimated to be pretty bad for the S&P 500, looking for about a negative 9% to the downside. And that's pretty much led by the energy sector. However, out of the stocks that did report early before the opening season out of the 22 stocks that reported, 19 have beat the estimates. So we kind of get the idea that the bar is lowered, so there might be surprise to the upside. So now one of the stocks that we're seeing is that we're back in the semiconductor sector. That is one growth sector that's doing well. Is Mellanox Technologies. The symbol is MLNX. They make high-speed chips for data and storage servers. And what's interesting about them is they broke out past the 48 pivot point in February, zigzagged around a little bit, and now they formed what's called a 3 weeks tight pattern. So we're not buying it now, but we're looking to see if it can take out that 55.80 pivot point. That may tell us that it's okay to go back in, and we'd like to see that on large volume. So you don't want to buy at this point. If you missed the original pivot, $48, you'd just be chasing it in no man's land now. So we want to see another setup, and the setup we're looking at here is 3 weeks tight. Now, what's good about Mellanox is last 2015 earnings came in at an increase of 131%. For 2016, we're looking at a 31% increase in earnings, and for 2017, an 18% increase in earnings. Now, they do have a lot of competition in this space, namely from Broadcom and Intel, so that's a little bit of the downside. So if you do try to trade, if it does break through 55.80, don't forget to use a stop tight, and don't forget to check with your financial advisor if this trade's for you. So, in summary, watch what the yields are doing, watch what the gold mining shares are doing, see if the indices can hold up on their levels, and as always, let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago.